Guess what, Jeff? We're live.
I know we are because I see it on YouTube, and I therefore believe you this time.
There you go. That's how it works. That is how math works. That's how science works. Hey, everybody. Welcome to the Investing Unscripted First Friday live stream on the second Friday of December. We had the streak going way too long, Jeff.
So it's worth pulling the curtain back a little bit here. And I was under the weather last weekend, still not feeling great if you hear it in my voice, but I could have done the show. Like if we had to do it, if it was like a live interview with a special guest, I could have powered through, but we decided to punt, figuring I'd feel better in a week. And I do. But I would be lying if I didn't say part of our discussion was it's kind of more fun to not do on the first Friday. Because it's kind of our brand. So I would say that was the tiebreaker, Jason. Like
Jeff,
that was
more of our discussion was about whether we needed to break the streak and get back on brand of not being on the first Friday, than the discussion about your relative health and the impact on the quality of the show.
Yes, correct.
Yeah,
and I do want to say like it probably we ended up punting probably. Mostly because it'd be funnier to do the first Friday's show, not on the first Friday. So here we are.
That's awesome. That's awesome. So Sina just dropped in a comment here. Sina, thank you for hopping in. It's good to have you on with us. Sina says, my reminder had a typo, first Friar. I will say I usually schedule out the reminder emails that we send out and the post that goes up. I did not do that. And Jeff did it. So blame the poor spelling on the person that works in public education.
So if it was on social media, I just literally copied the one from last month, which you did. If it was our Patreon email, then that was me typing and I probably just fat fingered it. So either way, glad you're here, Sina.
Yeah, Sina's going to have to let us know. We got John, of course. John Gagos is joining us, hopping in. Right on time, John. Let's see who else we got here. Alpcar, bleeding.
I don't get it.
I don't get it either. You're gonna have to cue us in. You're gonna have to clue us in on this one, Alpcar. Let's see here. John Dargan's joining us. Good to see you, John. It's great to have people here doing the live thing with us. A couple of things I want to say is as more people are joining us and hopping into the chat, we're going to answer your questions. So show up with your questions. If you can insult Jeff in some way, I will definitely answer your question. If you can insult me in some way, I will definitely answer your question.
Yeah.
So we love doing that. And hop on your podcast feed too and give us, we love to get reviews there. But for those of you that are watching the live stream, do us a favor and give us a like on the stream, because that helps the algo and it'll get served in front of more people.
Can I tell a story about reviews on the podcast apps?
Yes, you can.
So we frequently, not as frequently as maybe we should, we request that our loyal and even unloyal listeners do us a solid and give us a 5-star review and a 5-star rating and a review on the podcast apps. So a couple weeks ago, we got a review on Apple Podcasts and I appreciated it, but I was a little bit troubled by it because we got some feedback, which we needed to hear, which was the title of the post was not keeping up with the portfolio contest. And the comment was, it's the best part of the show now that everything else is behind a paywall. So a couple things, fair criticism. Not everything is behind the paywall, but I can get how this would rub someone the wrong way. And we've probably not talked about the portfolio contest as much as we could have. More on that later. But the review was accompanied by a 2-star rating. So Jason, what do we do with feedback that is not a 5-star rating?
We disregard it.
So I disregarded it. I haven't said this came in a month ago.
Yeah.
So I logged back on the other day to see if we had any new reviews, and the same review was there, but with a 5-star rating.
So, this is great feedback.
Yeah, this is fantastic
Excellent.
Feedback.
Excellent
Monster
feedback.
Truck Taxi Guy 83. Thank you.
Yeah, thank you.
We're going to talk about the portfolio contest.
And we're also going to talk about one of the reasons that we've talked about it less this year. And our goal going into the new year is going to be, you're going to hear about the new contest soon. Next Wednesday in our regular episode, we're going to roll out the details. It's going to be simpler this year. as much as anything for Jeff's sake, to make it easier for tracking. And it's something that we think we'll be more engaged with it as well going forward.
Yeah.
So,
and to clarify, it's not next Wednesday's show. It's the one that's going to go out on the 24th. That will give the whole spiel.
Yeah,
we have one in between. But yes, it's going to be simpler. We don't want to spoil it here. We want you to listen to the episode that comes out on the 24th. But that's where it'll be announced, the 2026 portfolio contest. We have a different way of thinking about it. We have some interesting ways to tie in the old contests. And yeah, I got to be honest, we've tried it 3 different ways in the 3 years we've done it. And this year was just too much.
Yep.
I got to be honest. So we'll finish out the year. We committed to it. We'll keep talking about it on the quarterly updates, but it's got to be a little bit simpler moving forward, and it will be.
Yeah, no, that's exactly right. I have one more response to the feedback that we got. And I do want to say we're glib about the whole 5-star reviews. Those are the ones that if people give us feedback that we respond to. We did see that 2-star review beforehand. And we do take that consideration into mind. We do. It sucks getting low reviews, right? So that's why we tease about giving us 5-star reviews. Those 5-star reviews, they really do help us. But the 2-star reviews with feedback that helps us do better does matter too. So thank you for the rating, and thank you for the review. And last thing, it's $5 a month, people. Come on. We're not asking for like $300 a year for.
But it's also not, there's not a lot, like most of the stuff we do is
there's
still
so
not
much
behind the paywall.
Jeff, stop. There's so much back there that's worth so much more than $5 a month.
Oh, I agree with that. I'm just saying it's not like we put the majority of our content behind the paywall. That's all I'm saying.
Yeah. I mean, just the Discord, the spiciness of the Discord is worth $5 a month, people. Come on.
Yeah.
Step up. All right.
All right. So let's pivot here. Let's kick off. We usually start the show with market vibes. It's like our monthly check-in on how we're feeling about the market. A lot has gone on in the past, I guess, 5 weeks, because I think we did this the first weekend in November last month. I have some feelings about the market right now. Where's your head as you think about, as we end the year, as we look back on the year a little bit, where is your head in terms of how the market is doing right now, Jason?
I mean, this is a typical year. It's funny. If you think about the returns, right? We're low teens at this point, I think, for the year, which is pretty typical. You know, the average over the long term is like 10 or 11%. But the typical year is usually like up 15% or more, or down, 8 to 10%. We almost never have an average year. So, I mean, that checks out, right? We had a downturn that was close to 20%. The market recovered from it. Checks out. Pretty typical that we see, one of those happen, every year or two. So there's all kinds of weird stuff going on and plenty of reasons to say, why is the market going up, right? The jobs numbers are probably a lot worse than what we've been seeing. Inflation's getting worse. So the Fed's in this weird position where it's having to prioritize 2 bad things. One that says you should keep rates where they are, one that says you should cut rates. So they're doing this kind of milquetoast, cutting rates just a little bit, hoping that helps with the employment side while we continue to deal with inflation. But yeah, I mean, there are always going to be reasons to sell. There's always going to be reasons to expect the market is not going to go up. But invariably, 3/4 of the time, the market does move higher.
I actually wasn't thinking this till you said it, but it actually struck me pretty significantly. The fact that this has been the least average year in terms of news since I've been paying close attention to the markets. And I would even throw the pandemic in there, because that was obviously a huge event, but it was a singular event that had a lot of repercussions, but it was like a thing.
Yeah.
There's been like 11 things this year. And from like a news and noise standpoint, I feel like this has been anything but an average year. But yeah, when you look at, unless we see some drastic change in the next, whatever we have left, 10 trading days or whatever, or 15 trading days, you're not going to this is going to end up being on paper an average year, which is just kind of wild considering how on average it actually was from a news perspective.
Yeah. No, I think that's a good way to put it. Let's see.
Here's the only other thing I'd add. And I know people don't like when I say this because it depending on where you are in your journey and your mental state when the market goes down, I really thought we were going to see a downturn. There was that couple week span when like the AI stocks started to, fade a little bit. We saw a couple red days in a row, a couple weeks where it was more red days than green. And then it just feels like you turn around and you're like, oh, what? That's all gone. And we're right back where we were with, near all-time highs for a lot of the stocks in our portfolios. And so, yeah, we'll see what 2026 brings. But I thought we'd get a little downturn here at the end, but it doesn't look like that's going to happen.
Yeah, I think at the low point, not too long ago, the low point, the NASDAQ was down about 8%. I don't know that the S&P 500 ever fell more than 4.5 or 5% here, the sell-off this fall that we saw. So that's exactly right. Let's see. We got any questions coming in? Guys, get your questions in. Folks, get your questions in if you have any. John Guy goes, yeah, there was the software, YouTube Studio software that we used to tie in from our production software to the stream was doing something different. So we did a little test right before 4:00. I'm glad we could amuse you. Yeah. It doesn't matter how many years I've done it. It matters how many times they change it. That's the thing to remember. Oh, here's a good one. Andy Frazier. This is good. Happy quote unquote first Friday, Andy. Happy first Friday to you too. John Denley. Thank you, John Denley. So it's not just me shilling here. John Denley says the rough cuts alone are worth the money. And the money's only $5 a month. It's easy. Patreon.com/investingpod. We will take $5 a month. John Geigo says Jason and Jeff are worth a venti coffee once a month. Man, I feel like a PBS station right here doing the drive.
Yeah.
It's like,
all right, we got to move on from.
Yeah. I'm looking for questions, and this is what people are saying.
We got two. Or we got one. It just came in twice. So
okay, who, what, where? Yep.
Who, what, where to asked us, what do you guys think about SHEL versus XOM? That's Exxon
Mobil.
Right?
Yep.
As far as investing and or dividends, thanks. So I don't follow this space at all, Jason. Do you have a hot take here?
Yeah, I don't have a hot take here, but I'll tell you this. So the biggest kind of on the surface difference is that Shell is European based, and ExxonMobil, of course, is US based business. And we've seen, you can look at Shell, you can look at Total Energies. There's a couple of other ones. I'm not even going to bring. Oh goodness, what's it called? I'm drawing a blank on the name, but there's another one that has a lot of offshore production. That's just a sucky company. I'm not going to bring them into it, but in general, we do see the yields on the European majors is higher. And there's a couple reasons why. Number one, you get dinged with a little bit of tax on some of those, depending on where they're domiciled. So you might pay a little bit of a foreign tax on that. But also there continues to be concern that these companies are set up to get taxed at higher rates in Europe because of concerns about basically because of renewable energy versus the hydrocarbons and the environmental impact. So that's the thing that kind of continues to weigh on them. And there's a few other things, but in general, the yields are just have been higher on those. I will say this, between Shell and ExxonMobil, I'd buy Total first. Actually, Total Energy's ticker TTE, better dividend. It's a more diversified business. They're one of the few multinational energy companies that have gotten into renewables and generally figured out ways to carve out money-making businesses in some of those things that they do. So they're one of one of the largest shareholders and a sponsor of Clearway Energy, ticker CWEN, which is a yield co that invests in and operates mostly renewable energy, utility scale stuff like wind and solar and some distribution assets and starting to get into storage a little bit. But they're one of the majority or one of the two companies that have the majority ownership of that business. And they provide it with a lot of top of the funnel, big deals that they're involved in developing. So there's a few things that Total has done well. So I would suggest you, if you haven't, go pop the hood open on Total Energies and go through their filings and take a look. And I think that's the better long-term investment than either of the other two.
Yeah, it's just not a space I've ever had any interest in looking into. Oil and gas, I just could not bore me more. Don't care. I don't really want to own oil companies. It's not anything I've ever looked at. All right, I have a question, Jason, for you and for all of the audience members to chime in here. What's the toughest investing decision that you're facing right now? Like, what are you struggling with? What have you been considering? What have you not pulled the trigger on? I have one I'll share, but I want to get your thoughts first, and then I want to see if anyone in the audience has a thought to share.
I think it's getting past this little bit of I don't want to say it's a mental block, but concerns about these mega cap AI or mega cap tech companies that have significant exposure to AI that's both upside and downside risk. And just investing through that. I have more cash than I should. We're coming up on the end of the year, which means that it's time for me to make my full annual contribution to my 401k. Between January and April, at some point, I will make one large contribution for the full year. I've done it that way for 7 or 8 years now at this point.
But you don't invest it all at once, right? So most of it stays in cash till you're ready to deploy it.
But I already have more than 10% of my portfolio in cash. So when I do that, it's going to put me with more than the amount of cash that I want to have.
Right. So you need to buy something.
What? Do I?
It sounds like that's what you're saying. If you're complaining about having too much cash,
I need to not let my biases about these large companies get in the way of me properly allocating. But I think part of my answer for that is, and we've talked about it on some other shows, other episodes recently. I talked about it on Motley Fool 24, the member live stream there, that I'm really starting to see some opportunities in like insurance companies, a few bank stocks that I like, that the valuations have gotten really, really compelling to me. That I think there are opportunities, but the thing that I'm dealing with a few of them is just not creating these really outsized positions. So I think what I'm doing is starting to accept that in some of those businesses that I've got really high, KNSL Capital, for example, I have incredibly high conviction in that business and the people running it, that I'm going to concentrate a little bit more than maybe I would have been comfortable doing a few years ago. Both taking on the risk, but also I expect it to be big winners. And then find a little more of my Dave Gardner with those businesses that maybe aren't really typical like rule breaker stocks, businesses, but be willing to let them win and concentrate more.
Yeah.
What about you?
Well, actually, what you just said is sort of tied to another question we got in the chat from John Denley, who said that is my question. How much cash is too much cash? Because that's actually a little bit tied to my struggle right now. I am not compelled to buy anything in my portfolio. Like I'm in like I'm bored by it phase. Just today, I got home. I was looking at my portfolio. I was thinking maybe I'll buy something today. I haven't allocated any of my December money yet. And I'm looking through all my stocks and I'm thinking about how the earnings were the last quarter, and I'm looking at the position sizing, and I just can't find myself compelled to buy any of them. And then I started looking at my wish list or my watch list, and I was like, maybe here. And then it was close to doing the show, and I closed the window and moved on. But that's sort of been my experience the last couple of months. I'm slow to buy. I don't feel the rush, and I don't know if I thought originally that was a valuation thing, like everything feels, expensive, and that doesn't keep me from doing my thing. But so what has resulted is, and I also sold a couple things about 3 weeks ago, so I have a little more cash than I normally do. I have more cash than I ever have had in my brokerage and IRA, like more than 0.5%, which is what I normally have in cash. I have a couple percent of cash And that I've never been there. So of course I'm now thinking to myself, well, maybe this is a good time to have a little cash on the side, right? If things are expensive and we might see a pullback. But then I think, well, that's actually me not being true to like my method, my process. So that's what I'm struggling with is I'm just kind of not inspired to buy anything right now. I'm not excited about any companies. And it's tied to the whole idea of like, now I have a lot of cash I have to figure out something to do with. But let's answer John's question. How much cash is too much cash? There is no answer to that, John. I don't think.
There are lots of answers to that.
Right. Yeah. Yes. There is no one singular answer to that, I guess is the better way to say it.
I think I can give a philosophical answer that I think gets to the point of it. It might be kind of unsatisfying for some people listening. Don't bring my wife into this, Jeff. But I think the philosophy matters is that here's the thing about it. Cash is a great safety net, but a bad investment, right? So if you need the safety net, and the safety net of cash can do two things. Number one, it protects you in the real world. So 3 to 5 years of expenses. If you're living off of your investments, whatever percentage of your investments are going to need to cover expenses in the next 3 to 5 years. And I'm saying I'm not directing that to anybody listening because, we don't do individual advice.
It's the royal your.
Right. The royal we is something different. Generally you would want to keep that in cash or something that's like cash. Because sure, you may miss the upside, but you're also going to miss the downside of either a market crash or a sell-off that's untimely or a single entity failure. You own a business that goes bankrupt or something unexpected happens to that business, or you own a bond that something happens with the business and it loses value. And the only way to recoup that value is to hold it. The company goes bankrupt, all right? Bondholders are in the front of the line before a lot of people. And there's a good chance bondholders get made whole, but you got to see the process through, right? Before you get made whole. And if you're selling, it's at a discount. So that's why cash is so important. Basically, all of the rest of the time, the only thing that cash does is give you some mental edge. If you get to the point where it's no longer a mental edge and it's a mental crutch, then it's probably hurting you more than it's helping you, right? Because it's always going to lag bonds. It's always going to lag the market over the longer periods of time, right? So if you're holding cash above what you need in that short term, unless it's giving you some sort of an edge. And what I mean by that is it's a tool that you can use without messing up other things that you have that are working, then it's an edge.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
Yeah. I mean, if I was going to give like a more detailed answer, then everyone has to figure this out on their own. I would say, two things. You were right to point out, we want to be clear when we talk about cash, like we're not talking emergency fund cash. That's a separate pile of cash. But if we're just talking cash for investing, I think you have to know what kind of investor you want to be.
Yeah.
Like I have always been since I started, and I still kind of consider myself to be just a fully invested investor. Like I don't purposely keep cash on the side for a reason. Whereas you do. You have a percentage you like to have, but you also have a plan to deploy it. And I think as I heard you answer that question, I just wanted to highlight that because I feel like cash on the side without at least some sort of framework around what you're going to do.
If it's just sitting there never getting deployed,
correct.
What are you doing?
Right. So like, I like your plan. Like you have all this cash, but you have the closest thing I've seen you have to a rule, which is the market drops this amount, I'm deploying this much cash. No questions asked.
Absolutely.
Done.
Yeah.
And if it's this much more, I'm deploying the rest of the cash. Like,
right.
So it might be there for 5 years until we have that, triggering event, but
like the
you
full
have a
amount,
plan for
but here's the math behind it. So my general rule is if we get a 20% sell off, I will have deployed just about all of the spare cash that I have back into the market because I don't need I'm still 15 years probably away from needing cash for my own income. I'm less than 10 years, I'll be paying somebody's, post high school education. We have another plan for that, right? That just has nothing to do with most of our investing. But we don't get those 20% sell-offs every single year. We might get one every few years, right? But we do get a 10% decline just about every year. And a lot of times that 10% turns into 15%. So we get a 10% sell-off. I'm going to immediately start looking for my favorite ideas to plow half of the spare cash that I've set aside for into. So it's not sitting there for years and years and years. It's sitting there until I see opportunities that are too compelling to just continue to walk away from. And the math says that works as a good way to help boost returns, but also by having that cash, I'm not constantly hunting for things to sell to come up with extra cash, right? And interrupting compounding that can just continue to happen because I'm looking for a reason to sell a stock to come up with a little bit of cash. So that's the kind of the methodology behind it for me. I want to hit, we were talking about the foreign dividend taxes, and I just wanted to follow up on that with, who was asking that? Was it,
who, what, where to?
Yeah. So, who, what, where, I believe mentioned, they're looking to do this in a Roth, just want more European exposure. The rules of a Roth are around U.S. taxes. The rules of a 401k and an IRA are around U.S. taxes. The taxes, the foreign dividend tax is the tax that is paid to the country where that entity is domiciled. And you can't recognize a foreign tax credit inside for those taxes paid in a Roth IRA. So again, I'm not a CPA, but in my experience, I own some of these foreign entities in my 401k. Those foreign dividend taxes still go out, and there's no getting them back. And the rules typically apply pretty much the same with Roth. So do your own due diligence on that, but just be aware that that's still a thing that is not, you're not shielded from that because it's Roths and IRAs are built for U.S. taxpayers based on U.S. taxes.
Yeah. Let's grab John Denley's follow-up to our conversation about cash, and then we can go back and hit some of the other questions people have asked. But John said, I'm sure you guys have seen the Morgan Housel cash deployment plan.
Yeah.
I don't know exactly what you're referring to, John. I know that Morgan Housel has talked about keeping just a ton of cash just because that helps him sleep better at night. And I think that's a perfectly reasonable plan if that works for you. Our good friend—
He's also very wealthy now. So
yes,
let's remember that.
Our good friend Lou Whiteman has at least said publicly, I don't think it's like a secret, that he keeps a lot of cash too, just because for him, that's just mentally
like
helps him
5
sleep
years
at
of
night.
cash kind of thing. Yeah.
Right.
Multiple years.
Yeah. To each his own. And look, it depends too, we're bleeding the difference between investing cash and like cash on the side for like, if you lose your job and stuff like that. But the amount of cash you have to keep for emergency plans, losing your job, I think also depends on the career path you're on. Like, what job do you have? Like, I'll give you
career path, dependence. What are your liabilities in the real world?
Right.
Thinking about your balance sheet of your life. do you own a home? Are you a renter? Do you have kids? Are you paying their college expenses now? Are you paying alimony? Like all of those things, that come into play where money has to go out. Who's going to pay insurance if you lose your job and the insurance is through your employer, right? Like all of those things.
Yeah, but it also depends on the kind of job you have. Like, so I'll give you an example.
Industry you're in, right? The
Right.
level of ability. Yep.
Like in my wife's industry, she can lose her job tomorrow, and it might take her a year to find another one. In my industry, it's very unlikely I would lose my job, and even if I did, I could find one within a week because there's a shortage of educators. Right. So we have different levels of like true risk of losing our employment, and that's different for every family, and that's part of what you have to think about. All right, let's go back and grab some of these earlier questions. Andy Frazier asked, I've held a small NBIS position since 2018. That's Yandex, I believe. Held through the delisting and the relisting, can't decide to hold or bail given the financials, not seeking any personal advice. Well, good, Andy, because we're not going to give you any. But yeah, this is a weird company. It was a Russian company.
Yeah, it's a Russian tech company. Yeah,
YNDX, I think, was the old ticker. And then it unlisted and relisted as NBIS, and now it's located in a different country and it does different things. So I don't know.
Well, it was frozen, right? It was like all these Russian entities were frozen when Russia invaded Ukraine.
Yeah.
And it eventually was delisted. Go ahead.
No, I was just going to say, I've not followed it much since it got delisted. I was a little bit familiar with it before all of that. But to the question of can't decide to hold or bail given the financials, I think this is the most common question that I've come across, and also that I ask myself: do I hold or do I bail? I was just thinking about it today with my own portfolio. I can tell you what I do, Andy, to try to answer that question is I always try to make myself go back and look at previous results, whether it's earnings calls or earnings transcripts, or whether it's the 10K or the 10Q or just the press release from the previous quarter. And if I really want to dig in, I'll do like a what and why protocol in my brain, where I'll be like, what do I see and why did it happen? What do I see and why did it happen? A lot of times asking myself those why questions gets me to something that helps me make a decision. But, and then I think it's just, you got to think about if it's something that will take a long time to manifest, you have to decide if the cost of tying that money up is worth it. How big of a position is it for you? Like, that's another thing. There's a couple stocks I've not pulled the cord on because they're like 0.001% of my invested wealth. So it's like the incentive to wait and see is pretty high when it's that small of a position. The $30 I'd get back by selling it isn't going to make or break my investing future. So that's a lot different than if it was my biggest position, which might be, a couple percent of my portfolio.
So it's a very different business than it was before. When it was Yandex, the thesis was this is the Google of Russia. And I had a very small position in it. I don't remember if it was originally based in Holland. But the new company is totally based in Holland. And I think was originally headquartered there, but then most of their operations were in Russia because it was a search business. But the new business that's emerging is an AI play. Like, it's an AI infrastructure play, right? So I've done zero research into it, but the biggest thing I would caution anybody about that owned this entity before and is trying to decide what to do going forward is just acknowledge that it is a very different business. And if you're the kind of person that doesn't typically do a lot of research into the businesses that you own, and you bought it because somebody recommended it, or it was a stock picking service that you went through and they're not following it anymore, this is one where I suggest anybody in that situation, you need to peel back some layers and actually study and find out what you own, because you're not owning the same thing under a new ticker and a new name that's now based in the Netherlands. It is a different business. So just be aware of that and figure out if it's worth owning. I can't give a cogent answer here because I walked away from it a long time ago and have had zero interest in going back.
I'm proud of you because not being able to give a cogent answer has never stopped you in the past.
True. That's true.
All right, let's move on. because this one is a little bit of a swipe at me, and I love it. Even though I don't think he meant it that way. John Dargan, Jason, do you know anything about Dexcom? I heard Jeff and a couple other fools talking about it last night. He's talking about the Motley Fools live stream for members. But sadly, I knew more about it than any of them. No offense intended. No one can know it all. No offense taken, John. I don't follow Dexcom closely. I don't know if Jason does, but we'll put him on the spot.
No, I don't. My wife works in biotech, so I've generally stayed away from most healthcare stocks because we already have a lot of income exposure tied to it and equity exposure too. I know it's a great business and it's dominant in the monitors, glucose monitors, continuous glucose monitors. It's a great business, but just put me in the same bucket with those other people. Sorry. Not sorry.
All right. Eric DeVore, who's back. We haven't seen Eric on the live stream in a while. Welcome, sir. He asked, or he shared with us, my concern is concentration and diversification. How are you supposed to outperform the market if you're not well over allocated to the popular names, but also want diversification at the same time? It's a great question.
Yeah, it is a good question. And
which surprises me coming from Eric.
Yeah. That's not fair. If Eric has good questions, he's just having good answers for him.
We've met Eric in person, so I feel like I can dig at him a little bit, not like someone I've not met yet.
Eric is actually, I'm dancing around his question because I think he's a good example of someone who the way they think about cash in the real world may need to be different than the rest of us. Eric works in the entertainment industry, doing things for TV and movies. And that work is almost all contract work, right? And it can be feast or famine from what, again, I'm not speaking for Eric's specific situation, but I lived in LA for a long time and I've known a lot of people that have worked in that industry, and you can have tons and tons of work or no work for an extended period of time. And you have to be mindful about that and how much cash you keep in the real world. Very different than somebody in education where mediocre people are guaranteed income forever.
That was a dig for the educators in the audience. He was digging at me, not you.
You're all awesome, except Jeff.
All right, we didn't answer his question.
No, not at all. Not at all. It's something that I've struggled with because I've talked about it before. You know, I've owned at different times. I've owned Apple and Amazon and Alphabet for periods of time, not very long periods of time for any of them, and none of them in very large amounts. Yet I was able to consistently outperform the market for the better part of 11 or 12, 13 years. I've actually struggled to outperform the market over the past couple of years, not owning them, but that's more of a kind of a change in my investing philosophy than, and not, you know, beating the market's not necessarily my North Star for my entire portfolio anymore. So I don't think you can't beat the market. But we actually just had a great conversation with Bill Brewster, the Business Brew podcast. That's our episode that's going to come out next Wednesday. And one of the things that we talked about is, what are you actually trying to do as an investor? What are you looking to accomplish? And he shared some experiences that he had that fundamentally affected how he invests. That his goal is to make a satisfactory rate of return, but it's more about kind of the high floor versus the highest ceiling. Even though that started to evolve for him from some conversations with David Gardner and other people that are more growth focused. So it's really about what are you trying to accomplish? And if your goal is to exclusively outperform the market, it's certainly been very difficult over the past 15 years if you haven't owned the Microsofts or the NVIDIAs or the Apples. But I do want to point out that for the most part, those companies were not one of the 10 largest stocks 10 or 15 years ago. And if you look at the turnover of the largest stocks on a rolling decade basis, there's a high probability that a couple of those might still be on that list as the largest, but there's going to be new businesses that emerge that are going to become the next largest enterprises. So I do think there's a lot of, driving forward by looking in the rearview mirror, by saying that you have to own the Mag 7, the Mag 10 to beat the market or do or do well looking forward. And a lot of that is coming from people talking their book that manage large pools of money, that they have to end the year with these big companies and big winners on their portfolios when they produce their end of year data that goes to their investors, because they need to be perceived as having owned the winners. So there's a lot of different ways to win that don't require you owning just those companies. The most important thing is having a framework that works for you, that you're going to be able to stick with, owning businesses that you like, that are consistently helping you check off the road marks as you're going down the road of your financial journey, that you're hitting your goals to reach the levels of wealth or income or whatever you're looking to do. You know, if you're vastly underperforming against the indexes that you're measuring yourself against, what are you even doing, right? Then you need to have some reality checks. But if you're deriving pleasure from it and it's moving you towards your financial goals, and your performance is pretty well in line with the indexes that you're measuring yourself against, then I don't think you should beat yourself up too much.
Yeah, I'll share a slightly differently worded version of what I said to Bill when we recorded that podcast with him. You know, if you look at my aggregate portfolio of investments that me and my wife have had since we were new employees in the real world as young adults, we are not beating the market. Probably not even close, because the vast majority of our invested wealth is in index funds and mutual funds and ETFs that aren't the market, right? So like the parts of it that are the S&P 500 index fund has matched the market, but there's target date funds thrown in there. There's bond funds thrown in there. There's different ETFs for different parts of the market that some have probably overperformed, some have probably underperformed, but I'd be willing to bet in aggregate, the portfolio has not beat the market. I can tell you right now, as I sit here on December 12th, 2025, we are on track to retire with plenty of money by never beating the market. So that's the first thing I would say. The second thing is, you can still be concentrated or diversified in your stock portfolio and get as much or as little exposure to those companies as you want. Like there's so many different ways you could play it. You could have some percentage of your portfolio in the S&P 500 ETF and then let the stock part be a little more risk on if you wanted to. Or you could have a concentrated portfolio of, let's just say, 10 or 15 or 20 stocks if you consider that to be concentrated, but one of them is an ETF that tracks the Mag 7 or tech stocks or AI stocks. You know, there's a lot of ways you can play it, where if the number of things in your portfolio is what's holding you back in terms of like thinking of it as being concentrated or diversified. Or you could just own some of those Mag 7 companies and a handful of other ones too. Like, I don't know. There's a lot of ways you could kind of get at it, but I agree with you, Jason. I don't know that the North Star of beating the market is the only way to reach financial goals, because I'm on my way to mine and I've not beaten the market.
Well, you bring something else up in there. You're talking about like target date funds and owning bond funds and ETFs and that kind of thing in real estate. You know, those assets all have their own benchmarks that they're going to be benchmarked against that are not the S&P 500.
Correct.
Because it's really important that you benchmark your entire portfolio accurately against those things. And if you're in your 401k, there'll be benchmarks listed with the different funds that you have. If you look on the prospectuses for those things, so you can see how they're doing against the benchmark they have. You go on Morningstar and it's going to immediately tell you, like, how do they stack up against the benchmarks that are appropriate for those asset classes. And the reality is that nothing works all the time. And that's the whole idea of asset class diversification, is that when the stock market writ large goes down, the bonds are there to offset some of those losses. And if you rebalance, you know, the bonds have held up, you decrease your bond exposure, rediversify into stocks, the market eventually starts going back up, it's going to go up more. A lot of investors have had a little bit of exposure to international markets over the years, and that's lagged the US. It's mostly, sometimes it's a little bit better. Real estate has had periods where it's done better, right? REITs. So it really is about measuring your returns for your stocks against the market, but also most important is staying very, very aware of your own goals. That's so much more important than getting too tied up in the idea of outperformance.
Yeah. All right. LDP has a question that's tied to a news item that was from today. I think it'd be fun to talk about. Hey guys, challenging question. Been invested in a stock for a year that suddenly sees a bump of 50% in a few days. How to know if it is time to sell a part it is due to the cannabis bump today? So I like this question because I was actually thinking about this exact thing as I read the news that, so if anyone missed it, I think President Trump signed an executive order today to reclassify marijuana as a Schedule 3 drug, which puts it, down with steroids and, Tylenol with codeine and not up in Schedule 1 with like heroin. So all the pot stocks jumped today. And that's obviously not complete, legalization, but a big step forward in terms of all the things that have been holding these stocks and these companies back. But that's a good question. Like when you see a stock jump huge amounts in a day or two based on one item of news like this, do you ever consider like, maybe I should take some off the table here, Jason? Like how would you, we can't answer this for LDP, but when you see these kinds of things happen in your own portfolio based on like a big news event.
So I think as a starting point, like just like the pure and, the allocation and thinking about long-term, there's a few different ways to think about it. Number one is if the returns that you've derived in this very short period of time, if you look at the market value of the business today, if you have managed to wildly pull forward years and years of returns, and it's hard for you to see substantial gains going forward from here, from this price, maybe it is time to move forward. Maybe it is time to move on a little to some degree. The other part too is like the sleep test, right? If you start to become fixated, if I have a position like this and like every time I log in to my brokerage, like this is the first stock that I'm going to check. Now I've got a bit of a mental problem, and maybe it is time for me to sell some of it so I can just leave it the hell alone, because now I'm investing too much time and it's interfering with me being objective with my portfolio writ large. So I think that's the two things that I would think about is, have you already gotten the gains that you expected to get? And, anything else is, you think there's more downside than upside at this point, or is it just preoccupying you? That's kind of how I think about it.
Yeah. A couple thoughts I have when this has happened to me, and it has happened. I'm trying to remember the last time something in my portfolio, I feel like jumped like 40% one day on some sort of news. I can't remember what. A couple things I try to tell myself. It is possible for a stock to jump 50% on something like this and then give all those gains back over time. Nothing is impossible, but it's, I would say, unlikely that it gives it back in the next like 2 days. Especially now it's Friday, the market's closed. It's not going to give it back. The earliest it can give it back would be Monday morning. It gives you time to think about it a little bit. So I think like first thing I would say is whenever things like this happen, I try not to feel compelled to make a decision immediately, especially if it's a Friday. That's the first thing. You have some time to think about it. I think trimming makes sense for all the reasons you just said, Jason. If it's keeping you up at night, if it helps you sleep better, if you feel like the gains are just not realistic for the business.
Yeah. If you're having to take one of those little CBD pills to help yourself relax.
But there's a reason when stocks jump, it's a reason that they jump 50% and not 47 and not 53 and not 28%, right? It's coming to a price that a large part of the market that thinks about what a company's worth and what it can do has sort of thinks is the right price based on this new news. Now, it's not entirely correct, right? The market isn't always efficient at all times, but generally when stocks jump on a news item like this, I would say most of that price movement is analysts and people saying, okay, now if this happens the way it's announced, we think this company is now worth this, and that's a higher price. So now I don't know enough about this executive order to know like does this mean it's definitely going to happen? Or, a lot of the executive orders we've seen have just been like wish casting, and they don't actually
I'm
happen.
glad you said that. I'm glad you said that, Jeff, because I wanted to bring that up. Marijuana is illegal because of the Controlled Substances Act. It's illegal because of a law. I think the administration can maybe move it from Schedule 2 to Schedule 3, but it would still be a controlled substance, right? It would still be federally illegal. So the president has limited ability. Like this is actually something that went to the Supreme Court a few years ago about what the administration had the power to do here. Congress would have to decriminalize it through either repealing, which they wouldn't repeal the Controlled Substances Act because there's a lot of things on it, or repealing the part of it around marijuana, or writing a law that specifically removed it from being a scheduled controlled substance. So just be aware of that, that this could be a temporary bump. Factor that into your decision-making is the best thing I can suggest, but you do you. We're not telling you what to do.
Yeah, just a follow-up from LDP. I never know if these price spikes come from institutions or quote-unquote dumb money, because we are talking
this is dumb money.
Billions in it one day.
Now it could be some percentage traders, momentum and traders, correct. And but they're looking for bag holders. So
right, but I will say this: if it gets rescheduled to Schedule 1, that is not decriminalization, that is not legalization, but it is a big step in the right direction. So these companies will be worth more if that actually happens. What I was trying to say with the whole executive order thing is there's a lot of things that the president signs as executive orders that he thinks magically mean they will happen, and they don't always. And or sometimes things get challenged legally and then they don't actually happen. I mean, and this is not just a Trump thing. There are executive orders that President Obama signed and George Bush signed that got struck down or didn't actually come to fruition, because what a president thinks they can do with a pen is not always what actually can be done. So I would say, though, that's where I was trying to go with, will it actually happen? And if not, you're going to see that price come back. But I can believe that a rescheduling of marijuana is worth 20 to 50% more for some of these businesses. That's a big step forward. Now, if it gets legalized, I think you're going to see another big jump. But I guess what I'm trying to say is I would want to see it actually happen. Like whatever the official act needs to take place for the rescheduling to happen before I'd be like, okay, I'm confident that this price or something near this price will stick around. That's what I was trying to get at.
All right. We got 10 minutes left. These always fly through here, but I can't not take Andy Mays here.
I know. I was trying to just hold off as long as we could.
I know you could, but I'm taking it. So Andy May, congrats on being right about Brookfield Renewable. I know you guys were on it for a while, so I bet it felt good, that little run up it has. What valuation would you start trimming? So Brookfield Renewable, ticker BEP, that's the publicly traded partnership. BEPC is the corporation. They're the same thing in terms of the percentage of the businesses that you own. There's some tax reasons why Brookfield Renewable Corporation trades for a higher price, and why its dividend yield is about 3.9% right now versus 5.4% for Brookfield Renewable. I only own the partnership BEP. That's like the one that I buy. I deal with the Schedule K1 for taxes, and it's worth it to me to get that higher yield. For me, I wouldn't even think about selling if the yield on BEP until it was like closer to 4%. And even then I probably wouldn't sell. Like, this is a business I intend to hold for the very, very longest of terms. I just think that all the Brookfield entities are so well run. The tailwinds for renewables are extraordinary, between the electrification of everything, the energy transition that's going on, the likelihood that AI is going to prove to be a thing that's going to take a shitload of power. It would be very, very hard for me to see a reason to sell Brookfield. I mean, I held through dividend yield getting less than 3%, back in 2020, 2021. I held through that. I was not selling through that. It's just a wonderful, wonderful business. I think it's going to be a compounder for a very, very long time. So maybe I'll sell when my kids needs money to go to college. No, he'll have his own money for that. So,
yeah, I mean, I've not had a position grow to a point where I'm uncomfortable with its size, and that's why I trim. So like I can't really speak to that. But a company like Brookfield versus a cannabis company that jumps up 50% in a day, in my mind, totally different calculus in terms of trimming. I've not ever trimmed a stock because of gains. And I don't think I would unless it got to a point where like, oh, now this is X% of my portfolio and I'm not comfortable with that. Or it did something ridiculous in a short amount of time that I thought was completely, divorced from the fundamentals. But those are two different reasons to consider a trim, I think, on a run up. All right, Andy just followed up by thanking us for posting content on the stock videos. So you're welcome, Andy. Thanks for watching them. We appreciate that and you being here. All right, Jason, we got about 6 minutes left. I need to leave a little bit before 5 o'clock. You're going to wrap us up, but let's answer one or two more questions here before we have to go. I see one here about WMB and Enbridge. I don't know either of those companies well enough to say anything good about those. Maybe you do.
I can. Yeah, read the question to me.
All right. Where did it go? Here we go. I own some WBM, and I was thinking about adding ENB. That's Enbridge. Any thoughts about Enbridge? Same idea, just looking for strong international dividend companies. Thanks again.
I think you mean WMB, Williams Co. If you're talking about Enbridge, those are midstream energy companies. And Enbridge does a little bit of more stuff. Enbridge is a solid business. It's Canadian based, so it has some really low cost assets it's able to produce, and it's consolidated. It's asset based there. So, I mean, those are solid businesses. I would just encourage anybody out there that's looking for dividends. You don't have to look for international companies to do that. Clearway, we mentioned, we just talked about Brookfield Renewable, Brookfield Infrastructure. They all own assets all over the world that produce a substantial amount of cash flows. So, and I believe the Brookfield, partnerships, I believe Brookfield's headquarters in Canada, but I think those are based on some of the islands, where we see like Bermuda, Cayman Islands, that kind of thing. I think there might be Bermuda domiciled. So you can own international entities that way and have exposure to lots of markets for renewable assets outside of North America. So you can look, there's a lot of ways you can get income from some really great businesses that way. Prologis is a US business, but they have a tremendous presence in Europe with their industrial real estate REIT. So there's a lot of ways you can get international exposure that you don't have to find oddball international businesses to be able to do it. So just wanted to toss that out there. Jeff, you got a roll?
I got another minute or two. So let me, I think we've gotten to all the questions that are in the chat, but let me ask one to you that I'm curious to get your thoughts on. So we don't need to go into a whole deep discussion about interest rates and Fed decisions and things like that, but there was a cut this week in the interest rate, another 25 basis points. And it was notable in the sense that it was like a three-way split on the votes, right? We had obviously enough members of the board to approve the rate cut. There was a couple that wanted to hold steady and not cut. And there was one, and we could all predict who it would have been, who advocated for a 50 basis point rate cut. My question is, this is like not the first time, but the first time in a long time there's been this much dissent, public dissent on a rate cut decision. And I want to know if you think it is a good or a bad thing that this dissent is sort of being aired publicly. Because I think what has happened in the past is they'd all vote the same way, and then you'd kind of hear whispers after the fact about this person who maybe didn't totally agree and kind of went along because it was what everyone else wanted to do, but they don't really think it's going to work, blah, blah, blah. Is it better that we just have people voting the way they want to vote and we just, majority wins? Like, what's your thought on that?
So I think one of the hardest things about the Fed, their board, is that what they do in the meetings is massively important. The decisions they make around interest rates are materially, massively impactful to the economy. But there's so much of those jobs that is about signaling that in some ways may be more important. So remember, we dunked on transitory, right? But did you really want the Fed chief standing up there saying, guys, we are hosed. This is out of control. And we're going to screw bondholders because we're going to have to ramp interest rates up way too much to stop it. But there's nothing else we can do. So everybody just, hold on to your butts because it's going to get really ugly. Is that what we would have wanted him to do? Or to try to placate and be calming in the way that he was and try to slow play it, and hopefully that the economic data would allow them to be a little bit more measured about the approach that they would take? I think you want them to kind of slow play it and be gentle, because if you're coming off the top rope, you terrify the markets and things get really ugly really, really fast.
Yeah.
So it's the dual mandate right now is brutal, right?
Yep.
Because you have two things that are moving in directions that your most important tool of interest rates, one way fixes one thing, the other way fixes the other thing.
Yep.
Right.
Yeah.
So it's brutal, right? If you swing the sword this way, you cut off the heads of workers as you're trying to cut interest rates to help, or you know what I'm saying, right?
Yeah.
So I think that's the hard part about it. Jeff, you got to go. You got to.
Yeah, I got to go. Thanks, everyone. Jason's going to wrap us up.
Yeah, I'm going to take one more quick question here before we go. But I think the biggest thing there is just, it's a tough job, and we're in a tough environment right now where I do think that we're going to hear differing opinions from people that are involved in the interest rates decisions, because this is the hardest time for that job. Because again, you've got two different things on the dual mandate. That the way you affect interest rates helps one thing and it hurts the other thing. And that's a tough position to be in. The last thing I want to say before I wrap it up, everybody, is John Gallegos, you misspelled Smart Centers. The Canadian stock, they spell centers with the letters moved around in different directions. So I'll tease you a little bit for that. Friends, thank you so much. We really appreciate everybody joining in on our live streams that's able to watch it live. For those of you that are listening to the recording, just remember it's the first Friday of every month at 4 p.m. Eastern, except when it's not the first Friday of the month, which is about half the time. So either way, thank you so much for joining us. We appreciate you listening. Hope everybody has a great weekend and a great holiday season as we move forward. Got some great content coming up for the end of the year here. Hope everybody enjoys it. Until we see you next time, everybody, always remember, we love to give our answers. They're just our answers. You can come up with your own. We believe in you. All right, we'll see you next time, everybody.